So with the market dropping across the board, from big tech companies to small growth stocks, opportunities are everywhere. But how do you know which stocks to buy? So this is my actual stock portfolio, and let's walk through my top 7 stocks to buy now, focusing on the 3 different categories of stocks that the data shows are the best deals in the market right now, while having a convincing story why they could double, triple, or in one case even 7x over the next few years. So let's get into it and start by putting my money where my mouth is by showing my personal stock portfolio. So to start the year, my portfolio is down along with pretty much every other tech investor, but if we zoom out a little bit more, over the past 2 years, it's up about $180,000 and 145%. Though that does include money that I put in as well, because Charles Schwab doesn't break those out. And you can see it's been very volatile during that time, rising, dropping a lot, and then rising again. This is partly because I like to invest in high growth tech stocks, which tend to have a lot of volatility, but I don't mind as much because I won't need this money for at least another 10 years. I prefer investing in what I know, and since I've been a solution architect for Fortune 500 companies for half a decade, technology is what I know best. And for everything else, I try to follow the data over emotion for the funds that I pick, especially during times like this when the market is acting completely crazy. And as we go, I'll share exactly how much I have invested in every stock, including some that aren't on this list. So starting with a stock that I recently bought that I've never covered before, but I see some extremely clear hidden value here based on the data in the market. So this is the first stock in the growth category. So my first stock to take advantage of this trend is VBK, the Vanguard Small Cap Growth ETF. So buying this ETF is like buying a basket with pieces of all the small growth stocks in the US. Growth stocks are companies based on how much they'll be worth in the future rather than how much profit they make today. Think of a tech startup that's doubling in size, or a company like early Facebook, Nvidia in 2022. But you might be wondering why the first stock I'm picking is in the growth category, considering growth stocks tend to underperform during periods of market crashes. They go up quickly in good times, but they crash harder during bad times. And so, given the stock market has been selling off recently, it brings up one question. Has the market sold off enough that growth stocks are a good value today? Well, look at this chart from Morningstar, comparing the valuations of different parts of the market. We can see that both large and mid-sized growth stocks are both listed as overvalued even after the recent dip. But small cap growth stocks, these are companies that are worth under $5 billion, well, those are currently trading at a discount. And in fact, these small cap companies are trading at a discount across all aspects of the market. It is classed as a high risk, high reward investment, but it is less risky than buying the individual small growth stocks, since these would be considered penny stocks at their current size. So this is just a way for investors like us to get in on these cheap growth stocks without risking all of our money on a pretty speculative company. But that leads us to the second stock, which is SLYG, the S&P 600 Small Cap Growth ETF. One of the big problems with small growth stocks is a lot of them aren't producing any profit. This second ETF addresses that issue, since it also focuses on small growing companies, but they also filter for companies that are profitable and are currently exhibiting strong upward momentum. This ETF has returned 95% over the past 5 years, and with growth stocks selling off so much in 2025, this holding might be ready for a rebound in price once the market starts to come back. I would also classify this as a high risk, high reward stock. But if you're wondering how you can find stocks like this without waiting for my admittedly slow uploads, let me show you a tool that can help you with finding and researching stocks that is brought to you by this video's sponsor, Investing Pro. So you may have heard of investing.com from their daily stock updates and market news. But if you click on the stock screeners button on their website, we can quickly filter for specific types of stocks, like this screener that shows you just companies that are small under the radar stocks that are currently moving up in price. Or if you like cheaper stocks, here's a list of just stocks under $10 per share. And just copying this list would have made you a 29% return over the past 3 months. But it's not risk-free. So we can dig deeper into this list by clicking Insights, and then we can just pick the stocks with the most upside. This can save you a ton of time with finding interesting stocks, and from here you can go deeper with your own research to pick the stocks that match your investing strategy and risk. But what I like about Investing Pro is they can help you with researching stocks as well, putting all the info you might need about a specific stock in one place, including simple tips that can tell you if a stock looks good or potentially risky. Or if you're like me and you like tracking what the top investors are doing, you can see the exact trades Warren Buffett is making and get an overview of his trading strategy, pulled straight from the official filings for you automatically. And I managed to get a special discount for you. Click the link in the description below to get 15% off your first Investing Pro subscription, which means you get the lowest price available. So thank you, Investing Pro, for supporting the channel and having some really cool tools. And now let's move on to our second category of value stocks. So these stocks are rated as the cheapest stocks for the price on the market. And even though in the short term, the market is a voting machine where meme stocks and marketing can drive the markets, in the long term, it's a weighing machine where it all comes down to the cash a company is making. So next, we have a stock that is absolutely churning out cash for their investors while trading at a reasonable price and potentially reinventing the future of fintechs while they're at it. So some context. The US is the biggest financial market on earth, but it's also a very mature market. And we saw millionaires and even billionaires being created when China first entered into the modern financial space. But today, a lot of the new growth in the financial sector is coming out of a new area, Latin America, with Brazil being by far the fastest grower in that new market. Part of this is that Brazil has some really interesting new fintech companies that are starting to compete on the global stage, and part of it is the Brazilian government is spending a lot of money to help out these companies. In 2020, Brazil launched open banking to allow their fintechs to share data from their customers with those customers' consent, making it easier to do business in the country. They also had a digital pilot currency for leveraging financial services way back in 2023. And by far, the biggest player in the Brazilian market is Nubank. Nubank is the incredibly fast-growing and now largest digital banking platform in the world. The company now has just under 95 million active customers, which is up 22% year over year, and over $28 billion in total deposits. One crazy number that they've brought up before is that 58% of the adult population of Brazil is already using Nubank's super app, which lets you do everything from banking to shopping to ordering a taxi to running your business. But not everything is rosy with this company. The company has historically had a pretty high valuation, which is why if we look at their stock price over time, they saw a decline and then a growth and then kind of some sideways trading for basically the last 5 years. The company's currently sitting at just under $50 billion at a PE ratio of 23, which if we look up the stock on Stockopedia, puts it on the more expensive side of the banking market. And so you might be wondering, how exactly is this a value stock? Well, because Nubank actually produces a fair amount of cash and the fact that the company is growing consistently over time, famous value investor Warren Buffett has actually bought a decent amount into this company. In fact, as of their most recent report, Berkshire Hathaway holds more than 86 million shares of Nubank, which is valued at nearly $1.2 billion, which makes me excited about the stock because it could be a rare chance where we can see growth and value within the same company if the company's price is sold off enough to become a good value, especially given how much cheaper the stock price has gotten over the past 6 months. And so then the question for investors is, okay, the stock might be a decent value, but why would it increase in value from here? Well, as we saw, Nubank already dominates the Brazilian market, but they have started to expand into other markets as well, including Mexico and Colombia, and the company has done extremely well in Mexico. And one stat that I think is kind of crazy is they had 5.6 million credit card customers in Mexico, up 70% year over year, and almost half of those people had never had a credit card before Nubank. Nubank isn't like a new US fintech that has to win customers over from some big bank. Nubank is entering an area that people haven't been connected to digital banking before and offering them modern services. Now there's some risks with this. They have to adapt their product to the local culture, their marketing is going to be all different, how they actually run the product is going to have to change. But as long as they keep running this playbook where they land in a new country, expand over time, and then move to another market, it seems like Nubank is kind of on this unstoppable rise through Latin America as we speak, which is why I currently have just shy of 1,400 shares in Nubank worth around $13,000, and it's basically flat over the period that I've owned it so far. But I'm happy to keep holding this stock. But next we have probably the most controversial stock that'll be on this list. Every time I talk about it, I get pushback, but I think that's because I haven't explained it super well in the past. So everyone get your pitchforks ready because stock number 4 is Intel. I know, seems like a crazy pick, and I don't think that Intel is a better company than an AMD or an Nvidia, but my play in this company is purely one based on value. So historically, Intel was one of the most important companies in the US. They basically dominated the entire semiconductor space, and in some ways they invented a lot of modern computing. The company basically missed the entire rise of GPUs powering things like crypto, AI, metaverse technologies that has launched stocks like Nvidia into the stratoverse in recent years. And the company's lack of ability to quickly pivot has led to some serious financial difficulties, including reporting a net loss of $18.8 billion in 2024. And remember, this is a stock that's technically in the same industry as Nvidia, which made $22 billion in just the last 3 months. And this has led a lot of people to worry that Intel could actually be in danger of bankruptcy. And so with that, a declining company that is at risk of bankruptcy, what does this stock actually have going for it? And I think there's two main things. Number one, Intel is one of the only companies that actually manufactures their chips on US soil, which is something that is becoming more and more important to US government officials as chips become labeled a matter of national security. This is the reason that some government officials have been pushing for TSMC to create a joint venture with Intel to take over their US chip making. And reportedly, they have reached a tentative deal on this chip manufacturing, so some of their fabrication should be able to stay in the US. But at the same time, a lot of this push for US-based manufacturing has been coming from a piece of legislation called the CHIPS Act, which more recently President Donald Trump has been pushing back against, at the same time as a lot of other Republicans have been defending the investments into the space. And so this has led to concern that if the CHIPS Act is canceled, kind of the last thing propping Intel up could collapse completely. And so that's kind of where the market stands on Intel. They see it as a failing company that could go bankrupt in the very near future. And I think a lot of those concerns are currently priced into the stock. So investors today are paying less for the company than it is actually worth because they expect the future to be so negative. Kind of like how you might not buy an iPhone today if the new version is going to launch tomorrow and you know it's going to be even cheaper. And this is where I think value investors could get a deal on the stock if the markets are being overly pessimistic on the company. And I think they might be, because I think that they're underestimating one thing with Intel: government intervention. So let's look at the two possible extremes with this stock. Possibility number one, Intel recovers and regains their footing as a top US chip company. The stock price would go up. Option number two, Intel doesn't succeed, they slowly bleed out, and eventually they go bankrupt. Well, in this situation, because US chips are so important to national security, I don't see a world where another company doesn't buy up their assets or the government steps in to bail out the company completely. We've seen TSMC express interest in buying parts of Intel, and President Donald Trump has talked about creating a US investment accelerator to manage the CHIPS Act and negotiate better deals, which seems like he just wants to stamp his own name onto something that operates very similar to the CHIPS Act, at least as far as semiconductor investors are concerned. And so I think the market is pricing Intel at a discount as if they are already going to go bankrupt, and so we can get a deal on the stock if we buy into the fear, which is all a long-winded way of saying that Intel's potential risk-adjusted returns look attractive. And that is the metric that the really big investors actually like to focus on. But if Brazilian fintechs and floundering semiconductor stocks aren't your style, the third value stock may fit better for most investors. And that is VSIAX, the Vanguard Small Cap Value Index Fund Admiral Shares. Say that 5 times fast. Morningstar's investing styles analysis actually found that small cap value stocks are across the board the cheapest stocks in the market right now, trading at only 75% of the price that they should be. This is an index that focuses on smaller sized value companies, and this is classified as a high risk, high reward play because it's a basket of very small, very volatile stocks. But I think it is a much safer option than trying to buy the individual small value stocks, since those would all be penny stocks. But now we get to move out of value and into some of the fun stocks. Our third category of core stocks are companies that strike a balance between growth and value. And one of these will be a stock that I've owned for a little while, and the second one will be a brand new stock that I've never talked about before on this channel. And after that, I'll share every stock that I currently hold in my personal portfolio. So this next stock for me strikes the perfect balance between growth and value. And to understand why, let me start by telling you about the Magnificent Seven and the undue influence that they have had on the stock market recently. So the Magnificent Seven are 7 tech stocks that have driven a huge amount of the rise in the market recently: Apple, Meta, Nvidia, Amazon, Microsoft, Google, and Tesla. Back in 2014, these companies collectively made up under 10% of the value of the S&P 500, the 500 largest stocks in the US. But that percentage slowly rose as these companies' stock prices rose, to where in 2024, more than a third of every dollar in the S&P 500 was in one of these 7 stocks. This meant the market was extremely concentrated, and a lot of the recent sell-off has come from these stocks in particular. In fact, we've seen some of these stocks, including Apple and Tesla, driving a substantial amount of the overall stock market's drop recently. And I made several videos talking about this concentration at the time. But not all of these stocks are made equal. So my next stock is not Nvidia or Tesla, not that I have anything wrong with those stocks in particular, but I see the best value right now in Google, otherwise known as Alphabet. Google's stock price is up 169% over the past 5 years, but with the recent sell-off, it is down 28%, bringing it below the low price that it saw back in 2024 and down to prices that we haven't seen since close to 2023. Now, I won't spend too much time talking about what Google does. They make most of their money from advertising revenue. They're deeply involved in cloud computing and AI, and they also sell physical products like their Pixel line of phones. But what's interesting about this stock is I want you to look at this first line of their earnings over the last 4 quarters. This tracks how much revenue they're bringing in, the raw money that customers give to them before they pay off all their expenses. 1 year ago, this grew at 15% year over year on $80 billion. 1 quarter later, it grew at 13.5%, then 15%, and in the most recent quarter, 11.7%, to the company now just shy of $96 billion in a quarter. That's almost $100 billion every 3 months that the company is bringing in. This company is still growing like crazy despite the current headwinds that they are facing. So that's the growth side of things, but then on the value side of things, the company's forward PE ratio, which is basically how much the company would be worth if we took their most recent quarter and forecasted it out 1 year in the future, puts them right in the middle of their industry and actually puts them slightly on the cheaper side in the software and IT services market. In fact, because the tech market has sold off so much, Google is actually sitting at a fairly average price for the overall US stock market, despite the fact that tech companies usually trade a little bit higher than other companies. I've also made several videos talking about how I think Google Cloud is still being underappreciated by the market, especially considering how advanced Google really is in the AI space. In fact, they kind of invented the whole generative adversarial network approach, which is what was used to create ChatGPT down the line. Now, not everything is rosy with this company. They are operating in the tech sector, which is going to be hit very hard by tariffs because they are one of the US's biggest exports. And because Google is a large cap core company, those types of stocks are not considered undervalued across the entire market right now. And so there is a chance Google's stock price could continue to dip for a few more weeks or even months from here before it eventually rebounds and goes to a higher price. But I believe in the company enough to own 123 shares in the stock, currently valued at $18,000, and I'm down around 11% in the stock overall. And by the way, if you look up Google's ticker symbol, GOOG, there are 2 types of shares. C class is the type that I currently own. Which leads us to our last stock, and this list isn't in order, but I think these are all interesting stocks that are worth getting on your radar. And after this, I'll show you every stock that I currently own. So our next stock runs the world's largest global financial processing network. In fact, VisaNet is capable of handling over 65,000 transaction messages per second, and they have been investing heavily in acquiring AI fraud fighting tools, including buying the FeaturePlace platform recently. The company has also acquired several other platforms, including Currency Cloud, a platform that is focused on cross-border payment solutions, which is already integrated with more than 3,400 banks and financial institutions. Now, Visa is an interesting company in that they have actually underperformed the majority of other credit card companies in recent years. This chart shows them compared to MasterCard, the S&P 500, and American Express. And on top of that, the company has been selling off pretty aggressively since the start of 2025. The stock price is down 13.6% since then. And remember, this is a credit card company, not exactly the kind of company that struggles making more money. And I think there's 2 reasons for this dip, which could tie into why this stock would rise from here. here. The first is government regulation. The Justice Department under President Biden back in September 2024 sued Visa for monopolizing the debt markets, saying that more than 60% of debit transactions in the US ran on their network. And then the second risk comes from how Visa makes money. They make most of their money when a customer swipes their credit card. They take a small fee for that transaction. And so they're basically tied directly to how much money consumers spend. Now, as of late 2024, US customer spending remained largely resilient, but with incoming price increases as tariffs take effect, plus just overall concerns with the economy, that could hit how much consumers spend, causing Visa's earnings to drop as well, especially because Visa is a truly multinational company. They don't just make their money in the US, they also make a substantial amount of their money in Asia Pacific, including in China, which has been having a lot of issues recently with weak business sentiment and some real estate issues. And so I think the play with this stock is waiting until the tariffs fully take effect, waiting for that hit to consumer sentiment to actually happen, and then buying into the stock once it is fully dipped. I personally don't think it's at the bottom of where it will be, and I think once this PE ratio gets down below the average for their industry, then the stock price will start to look attractive to me. And so this is a stock that I just want to get on my radar and watch for the next few months and look for the buying opportunity, probably closer to a PE ratio of around 20. And I promised I would show you my full stock portfolio, so here it is. I'll also be sharing this over on my Instagram along with daily stock breakdowns that I post over there. And if you're ever wondering what are my top stocks overall, these are the stocks that I'm currently holding. And if you like this video, YouTube thinks that this is the best video for you to watch next.